new inflation information is out in the United States for the month of November. Consumer prices rising 2.7% compared to a year ago. The fresh data marking 2 consecutive months of rising inflation. Okay, now to talk more about this latest information, what it means for the U.S. economy, we're joined by Michael Collins. Michael's the CEO of WinCap Financial and an adjunct faculty member at Endicott College. Michael, good to see you. Welcome to our program.
Thanks for having me, Sean.
Okay, so inflation slowed significantly since its peak. It's down a lot. But the latest numbers do suggest that progress has stalled. So firstly, what is causing that? It is a sticky issue, as we have heard, but still far off the 40-year highs that the U.S. just really suffered through.
Yeah, the biggest contributors to year-over-year inflation, at least, are still rent as well as auto insurance. Those are the biggest pain points right now to inflation.
Okay, so as you mentioned, housing remains just a major driver of inflation, making up for a significant portion of the rise in November. And we're talking about all kinds of housing, rent as well as home ownership. So let's talk a little in detail about what sort of landscape in terms of housing or shelter that Donald Trump is inheriting from outgoing President Joe Biden.
Yeah, well, you have a ton of people locked into their homes because they got an attractive sub 3% mortgage rate during the pandemic, and moving anywhere else to lock into a 6.5%, 7% mortgage rate just seems very unattractive. So a lot of the inventory right now is locked up. The elevated mortgage rates actually also allow landlords to keep on increasing rent. We think one of the key levers to unlocking housing and lowering rents is going to be lower interest rates on the mortgages.
Okay, so that's not going to come overnight. So how do we get through this period?
Yeah, I mean, it will be interesting to see what happens next year, because as rates have been cut, mortgage rates have spiked because the mortgage market or the bond market doesn't necessarily know what to believe for policy next year in terms of rate cuts. So it's going to be a little bit of walking on a tightrope. But with the Fed poised to cut rates again next week on the 18th, we think mortgage rates eventually start to come down. Even the premium between treasuries and mortgage rates are actually at an all-time high or near historical highs.
Yeah, and from the information I was reading through, anywhere from 96 to 99% of the people involved in that field believe absolutely that the Fed is going to cut on the 18th. So let's talk about Fed Reserve Chair Jerome Powell. He recently expressed concerns about this inflation sticking above the 2% target. Now, overwhelmingly, the markets are expecting a rate cut, as we just talked about. But what kind of long-term concerns remain out there for the United States economy?
Well, if the Fed moves too quickly on cutting rates, they risk inflation being stuck above 2%. But the other concern, which I think is more important, is if they move too slowly, they could risk a sharp rise in the unemployment rate. Now, this past month, we only saw unemployment tick from 4.1 to 4.2, so we believe that gives the Fed enough ammo to do another small cut by 0.25%. But that's the environment we're dealing with. That's the tightrope we're on.
Yeah. Okay, so what role does stronger than expected economic growth play in these inflation trends? And how should it shape future monetary policy? Because let's remember, in simple terms, inflation means we're paying more for goods and services.
Yeah, we're paying more, but the economy is relatively strong, and we still see a lot of that strength. So what this means for the market is that going into 2025, the pace of rate cuts is uncertain. And if the economy remains strong, the pace of rate cuts will be slower. The silver lining of this is that when we do actually eventually have some kind of market disaster, the Fed is going to have plenty of ammo to cut.
Okay, the Fed has cut interest rates by a combined 0.75 percentage points since September. So it looks like policymakers needed to worry more about the labor market. Remember that time when they were talking about that several months ago, and less about inflation. So put that in perspective, because there's always something out there.
Yeah, there always is something out there. Personally, I would rather have an environment with a little bit higher inflation and everyone who wants a job can find one than inflation tumbling down because of higher unemployment.
Michael, real quickly, any wild cards out there?
Yeah, I mean, what happens with Trump policy going into 2025? there's a lot of things he said, but what actually happens, whether it's mass deportation or aggressive tariffs, right? Those could increase prices and keep rates higher for longer. But the market right now believes a lot of that is negotiating posture.
Yeah, indeed. Michael Collins, thanks so much for your insight. We appreciate it, my friend. Thank you.
Thank you, Tom.